Hello there, this is top-rated forexbrokers.com, and we continue our trading academy with one of the most interesting themes for beginners. What is technical analysis? Have you ever wondered, as a rookie trader or a starter in the FX trading industry, why everyone talks about fundamental analysis or technical analysis? Well, fundamental analysis, as explained here earlier, represents the sum of other factors outside what is happening on a chart. Other factors like economic news, geopolitics, and so on that influence a currency pair, while technical analysis represents the way traders interpret charts, like this one. This is the Euro-US dollar example on the 4-hour chart. Now, in Forex trading, all we want to do is either go long or buy, or go short or sell. In doing that, throughout the years, even before personal computers and even before the trading platforms that we have these days, traders try to look for market patterns or for chart patterns in order to interpret the future conditions for the market. And at the very start of technical analysis, there was a trend line. For example, on this Euro-US dollar here, it is obvious that the market rises with a very sharp trend. This is the line of the trend. This is technical analysis. The way you draw the trend line is technical analysis. It makes no sense to go short or even to consider going short until the trend line or the line of the bullish trend is broken. Of course, this is the very basics of technical analysis, and we want to emphasize here that everything starts with a trend line. All the concepts that were developed were moved forward from this trend line. What do we need for a trend line? For a trend line, we need 2 points. Not 100, not 1000. For example, here, this is 1 point, and this is another point, and then we simply drag. From this moment onwards, we already knew that as long as the price stays above this trend line, we don't want to sell. We want to be on the long side, or at least we want to ebb on the long position, like buying on dips, and so on. So this is a rising trend line here. From this moment on, everything gets complicated. In the 1940s, a wonderful trading theory was invented, and we will discuss much of this theory here on the Trading Academy, Elliott's Waves theory of 1940s. There were no personal computers, no charts, nothing, simply looking at the price action and interpreting the patterns. In time, technical analysis was split into 2 approaches. Let me write it here on the screen. Everything started from the United States of America, and that is called the Western approach. And under the Western approach, the article that comes with this video will treat all the patterns under the Western approach, such as the head and shoulders, the rising and falling wedges, the pennants, the bullish and bearish flags, and so on. Many years later, the Westerners were surprised to find out that the Japanese had a very interesting approach to trading or technical analysis. The Japanese approach made a lot of sense. The Japanese approach, most of it deals with interpreting candlestick charts. For example, look at this one. And then zoom in. We see that these are candles. The Japanese approach interpreted these candles here, with most of them being reversal patterns. And doing that, the Japanese focused on projecting future prices. The power of the Japanese candlestick technique was so great, and the Westerners were so impressed that they went on to adopt the candlestick chart. Up until then, there were no candlestick charts, only line charts and bar charts, and now we have the candlestick chart, which is the most popular and first choice amongst Forex retail traders. Over this course, we will examine many of these technical concepts. We will address most of them in our project, All the reversal patterns with the Japanese candlesticks techniques or classical ones with the Western approach will touch trading theories like the gun and the Elliott wave theory. And what's even more important for you to understand is that the Forex market always changes. It changed a lot already and will keep on changing from this moment on. Think of 10 years ago when the spread on the Euro-US dollar pair was 3 pips. Or the difference between the bid and the ask price was 3 pips. Therefore, charts were very different a decade ago. Nowadays, the spread between the bid and the ask price on the Euro-US dollar was 0 point something. Therefore, candles do not have that kind of slippage. So that the way the market is presented to us changed, and technical analysis has to change too, and it will change in the future. Expect new techniques to appear as part of technical analysis. There is not only trend lines and trading theories, but also plenty of indicators. So let me show you them here. There are Bill Williams indicators, cycle indicators, math operators, momentum indicators. These are basically the oscillators. If you choose any of the oscillators from here, it will be plotted at the bottom of the screen. We will treat most of the oscillators. The idea of an oscillator is to compare the move the oscillator makes with the move the actual price makes. The purpose is to find out which one of the two lies. Typically, the price makes a fake move, as this is a dog-eat-dog world. But how do you know when that is actually the case? That is why oscillators are here to do that job. We also have, in part of technical analysis, overlap studies or trend indicators. It doesn't matter if you use the MetaTrader or this one, the Forex. It is just another trading platform. But if you use the MetaTrader, this is the MetaTrader, it is exactly the same. You go on the insert indicators and you have trend indicators and oscillators. Some of them, and you can import others as well. I think you've got the picture now as to what technical analysis is, and we'll move on to the next part of our Trading Academy, showing you how to apply various indicators in a chart, both on the Forex and the MetaTrader, as two of the most popular platforms for retail traders. Thank you, and let's move on.